Okay. Thank you very much for inviting me. So this is a very, very interesting paper, and I found it hard to disagree with things. I think it's a great overview of what the issues are. My comments will be sort of actually quite inspired by what was in the paper. I'll sort of point out to some of my own research that sort of relates to these things, but I will probably not have a lot in terms of criticism of what's in the paper itself. So the first thing that I would like to sort of briefly discuss is how the paper starts. So it starts by saying that there has been a big change since the 1970s in how we think and what the issues in the context of capital taxation are. So there are many different components of that. So we're academics, so there were of course major developments in economic research on these things, and sort of the way the literature has progressed was by identifying reasons why we may not want to tax capital income. So there is a bunch of results in the literature that sort of point to high cost of capital taxation. Atkinson-Stiglitz result, Chumley-Judd result, perhaps to some extent Diamond-Mirrlees production inefficiency result, which sort of calls for not interfering too much with the production process. Now, the sort of the more recent literature sort of tries to understand the arguments for why we should have capital taxation, and this is in particular new dynamic public finance literature, but sort of older papers by Ayagari, for example, and sort of a number of other contributions. In a way, I think this literature is not extremely convincing in sort of building the case for the kind of capital taxation that we observe in practice. So we're sort of just picking up on what Mike was talking about. The key channel in the context of new dynamic public finance literature is the value of insurance. So the reason we want to have capital taxation there is because we want to insure people, but if we insure them too much, we kill incentives, and capital income taxation or destruction of saving turns out to be sort of the appropriate way of encouraging saving. So then you sort of start thinking about where does it apply in practice, and you have to think about sort of two types of issue, or two types of things coming together. One is that there is uncertainty that we want to insure against, and the second one is that we actually value providing that insurance. So even if there is uncertainty, if people are more or less risk neutral, or if they are very rich, we probably don't care about that as much. So it sort of becomes a very interesting case for thinking about how we should treat savings, but it's not. At least not to my knowledge, it's not a case for capital taxation of high net worth individuals, where a lot of capital taxation is taking place in practice. So this is one aspect. Another thing that has changed is that the economy looks very different. So that has been discussed. There is a lot more international capital flows. The role of multinational corporations is much bigger than it used to be, and that sort of opens up a lot of different issues. Yet another thing is that there has been a lot of financial innovation. So not sure to what extent it's endogenous, to what extent it's exogenous, but the ability of especially in the corporate tax context to reclassify debt as equity, or the other way around, and to sort of pursue aggressive tax avoidance strategy likely has increased over time. And these are sort of the constraints that may not have been, well, they probably were important in the past, but they were sort of not at the forefront 40 years ago, and they are extremely important nowadays. Yet another thing that has changed, and that maybe, and I'm not completely sure what implications it has, but I think it's sort of interesting to think about that, is that especially if you think about who is earning capital income, these may not be the same people nowadays that were capital income earners 40 years ago. So, one place to see that is sort of work of Piketty and Sayers, where they sort of document trends in income inequality and show that a huge factor in that, and arguably the dominant factor in the rise of labor income inequality has been, in the rise of income inequality has been labor income rather than capital income. So you sort of look at the top of the distribution. It's not that capital incomes are not there; they are there. But sort of in terms of the relative importance to capital income has declined relative to labor income. So the growth in inequality is sort of associated with working rich rather than non-working rich. Sort of interestingly, if you look at wealth concentration rather than income concentration, it's harder to measure. There are fewer papers on this, but at the very least, the evidence on the growth in wealth concentration is not as robust as the evidence on growth in income concentration. So if you sort of take recent work by Piketty and Zuckman, maybe sort of things are happening with a lag, and we are only now starting to see wealth picking up relative to overall income. But at the very least, like what we see in terms of income distribution and wealth distribution suggests that there has been some sort of transition that has been taking place. It has not been a steady state for the last 30 years by any approximation. So I have a paper with Lina Edlund that sort of tries to make that point in particular, that what has happened at the top of the wealth distribution is that we have more active new wealth rather than inherited wealth. That since the 1970s there has been a big change in the identity of top wealth holders and in the identity of who actually makes or who controls capital incomes. So does that have implications for how you think about capital taxation in general? Presumably, these are sort of different types of investors, investors who are more active, where the entrepreneurial component of wealth may be more important, and in particular, these may be types of income that are much harder to distinguish from labor income, because these are incomes of people who have a significant labor income component. So now, if you sort of look at where and this will be oversimplifying enormously, but where kind of the logic of the U.S. income tax and sort of the logic of income taxes in many other countries comes from, sort of one way of starting organizing things is by talking about Hayek-Simons and sort of comprehensive definition of income, and there you sort of think about individuals' ability to consume. Both labor and capital income represent your ability to consume. That's one aspect of it. Another aspect of it is that labor and capital income, two different types of income. There is some notion that maybe we should treat them in exactly the same way, and it's very difficult to come up with a different argument for treating labor and capital income in kind of the same way, imposing the same personal income tax rate on your earnings from a job and the same marginal tax rate from on say dividend or interest income, other than somehow thinking that these are two different types of compensation that would be difficult to distinguish. But then you start thinking about it, and dividends and interest income, these are not really the main categories where the reclassification of labor into capital income should be happening. So sort of the logic for how the system looks like is like it sort of feels like historical logic rather than economic logic. Having said that, the argument that labor and capital income should be treated in exactly the same way is out there, and the main reason why we may think about it is income shifting, and there is a lot of evidence that it happens. So one well-known category of responses is sort of organizational form of firms, where you can you can shift between corporate and personal income taxation. You have sort of directly form of compensation, sort of classic examples like I renovate a house and buy a house, renovate it, sell it, and earn capital gains. If I did exactly the same thing, but was employed to do that, this would be labor earnings. So now I converted labor into capital. Sort of bigger things like carried interest that sort of blur the line between those two things. We have evidence that these things are happening. We know that people respond. Firms may respond by retaining earnings. So I'll advertise my new paper with people from Norway, where we sort of document that part of the response to a dividend tax increase was sort of retention of earnings by small, closely held firms that are not necessarily used in a very productive and earnings are not necessarily used in a very productive fashion. If you start thinking about it this way, all right, so there is an argument here that this is an important distortion. That distortion calls for some form of integrating labor and capital income. It's not all of capital income. It's some part of capital income that to which it applies. So if you sort of are worried about that problem, fine, you can sort of go in that direction. But you are also taxing other types of capital income where the efficiency cost may be high. It's more likely to apply to, so this argument is more likely to apply to excess returns rather than, or excess returns or including rents, rather than safe return to capital, which kind of builds a coherent logic for maybe not the type of the system exactly the type of the system that we have in place, but some form of integration of capital and labor income with preferences for the types of capital income that we can identify that would be particularly distortionary. And that has been highlighted. This distinction between normal and excess return is it's not just an academic idea. It's something that has been applied in a few countries. Right. So Alan was highlighting problems with consumption tax as well, especially the transition relief. But once you start thinking about all of this, what is the alternative to thinking about income taxation? The alternative is to think about consumption taxation. So idealized consumption taxation wouldn't have at least wouldn't have the same types of problems, because one big thing that it allows you to do is not to try to distinguish between labor and capital income. So if you wanted to tax all labor and capital income at the same rate, then fine, maybe that could work. But if you don't want to tax them at exactly the same rate, then you have a problem. You have to somehow figure out what's labor, what's capital. The consumption tax does not do that. So the big benefit of a shift in this direction is just reduction in complexity. All right, so I'm running out of time, which I didn't expect because I have only 4 slides. So let me say a few things about estate taxation. So Alan didn't have a lot of time to talk about estate taxation. We know that estate taxation affects decisions, at least some decisions. We know that it affects reported estates, it affects gifts, it affects tax avoidance, it has effect on charitable contributions. It's much harder to establish whether it has real effects. Does it really affect labor supply? Does it really affect wealth accumulation? Econometric problems in this context are really, really hard because we are talking about a tax that will hit you, many years from now, and we are asking how your decisions are going to respond nowadays. Now, so to briefly summarize how I'm thinking, and I've done quite a bit of work on estate taxation, how I'm thinking about how estate taxpayers, high-income individuals are behaving. So there are a few important things. So one is that there's probably not one bequest motive. People are heterogeneous, and there's a lot of evidence that different people make different decisions. But one aspect of what high net worth individuals seem to be valuing is controlling their wealth. So you can see it in various ways. They don't maximize tax avoidance. That doesn't mean that they don't care about the taxes. They do plan to some extent. They delay planning until sort of as late as it's possible. Basically, it's very hard to make sense of the data without some form of utility from the stock of wealth. So somehow high net worth individuals put some value on wealth rather than just the consumption benefits of these things. Why estate and inheritance taxation is different than the rest of the capital taxation discussion? I think it is distinct, and it's distinct because it sort of touches on this question of equality of opportunities versus equality of outcomes. And much of the literature, actually, by design of the models that they use, kind of misses that point. So basically, once you start assuming altruism and sort of dynastic types of models, then you have one generation, or you have one family line, and you cannot think about sort of carefully think about how different generations should be treated. The one channel that comes up there is whether just overall the level of giving should be higher or lower. To me, that's not the most interesting channel. Maybe it should be higher, but it's not a channel that allows you to understand how estate taxation should be varying in the society.